The final jobs report card before Tuesday's election is in, and it paints a rosy picture for U.S. workers looking for growth in hourly wages. Hourly earnings rose 2.8% in October. Meanwhile, the nation's unemployment rate held steady at 4.9%. Joining us now with more analysis is WSJ Chief Economics Correspondent John Hilsenrath from our Washington Bureau. John, thanks so much for being with us.
Great to be here.
So, John, 161,000 jobs were created in October, just shy of what economists expected. What's the message to voters heading to the polls next week?
Well, the message you get is going to depend on which candidate you're listening to. I think the Trump campaign described it as a disastrous report because so many people have left the labor force in the last few years. But, you know, I think what you'll hear from the Clintons, and which is probably closer to the truth, is that the job market is improving. I mean, it's not a gangbuster labor market, but we have an unemployment rate of 4.9%, which is back within kind of its historical norms. And most importantly, we're seeing wages starting to pick up again. You know, wages had been growing around 2% for most of this expansion, which is barely enough to keep up with inflation. But now they're up to 2.8%, and that's the biggest gain that we've seen since 2009. So we're getting some improvement. Things are slowly grinding out to a better job market.
Is the consensus there then that wages will continue to rise?
Right. It is that they'll continue to rise. You know, we've seen a pickup from 2 to 2.8%. And I think what's happening is as slack in the labor market gets eaten up, as the unemployment rate comes down, it was over 10% a few years ago. As it comes down to below 5%, there are fewer potential workers out there for the jobs that are available, and companies are finding they've got to pay people more to keep them or hire them.
Higher demand for labor. All right. So, John, Americans head into this election with the second lowest pre-election jobless rate in 40 years. And as we just discussed, the fastest wage growth since the recession. So wouldn't data like this normally tend to help the incumbent's party?
It would, but, you know, there's nothing about this election that's like elections of the past. So, you know, talk about that jobless rate number. Yes, the jobless rate number is pretty good, but there's also a lot of people who've been left behind. There's a large number of people who have part-time jobs and want full-time work. There are a lot of people who left the labor force because they just didn't see great job prospects. So if you look at broader measures of unemployment, they're closer to 10%. Now, that's been improving, but it's still elevated. And then the other thing is we have what I would call scarring for a lot of people. It is the case that the job market is starting to improve. It is the case that wages are starting to pick up. But if you talk to many American households, you know, median household incomes, when you adjust them for inflation, are down from 15 years ago. So there are a lot of people who feel like they've still been left behind, like their standard of living hasn't improved for more than a decade. And they're going to take that out on the incumbent party. And that puts Hillary Clinton in an uncomfortable position. Right,
so this good news doesn't personally resonate for them. All right, so John, you wrote on WSJ Pro today that this jobs report sets the stage for a December interest rate increase. But there is still another jobs report to come in early December before the Fed meets to possibly decide to raise those rates. Do you think there's been enough growth this far to keep that on track?
It does look like it's on track. The Fed has been talking about this for months. They've been talking about raising rates all the way back to April. And they kept hesitating because they were worried about stock market turbulence. They were worried about Brexit. They were worried about what was happening in China. You know, we're finally at a place where it looks like the economy's on stable footing. We're getting steady job gains of about 170,000 a month. And so it would take a big negative surprise, a big negative shock to throw them off a rate increase in December. But we have to remember, when we talk about interest rate increases, we're talking about them going from less than half a percentage point on short-term overnight interest rates to less than 3/4 of a percentage point. So even when the Fed moves, we're talking about very, very low interest rates.
Right.
And that probably isn't going to change for some time.
Not a dramatic move. All right, John Hilsenrath, thank you so much for that.
Sure thing.